Good morning, everyone. Today's topic is analysis of financial statement in Unit 2. So let's get started. First of all, we'll see the meaning of financial analysis. What is the financial statement analysis? Financial statement analysis, it is also known as financial analysis and interpretation of financial statements. Now, why the financial statements are required for any business to run? We need to show the balance of the assets and liabilities of a company and to know the profit and loss of any business which are running the business. Now, the analysis of financial statement is required mainly to understand whether the company is earning profit or the financial soundness of the firm is there or not. What is financial soundness? Whether the business can exist in the market for a longer period of time or not. So financial statement analysis and interpretation helps the business to understand whether the company have the capacity to earn profit and whether the business is having the power to exist in the market in a long period of time. So in financial statement analysis, the process of determining the strength and weakness of the firm is also done. Now, what is the strength and weaknesses? If there is a strength, that means they are having the power to earn profit in the future and can grow in the longer grow for a longer period of time. And in weaknesses, if there is any kind of weaknesses in the statement like balance sheet or profit and loss account, then the company have to renew the balance sheet and profit and loss account and to find out what are the problems they had that they faced weaknesses in the company to grow. So for that reason, the financial statement analysis is used, and it is helpful for the managers or the management to judge the balance sheet and the profit and loss account whether to have a profitability or the soundness of the firm. So this is just the meaning of financial statement analysis. Now let's see the objectives or and importance of financial statement analysis. Now, the first objective is to assess the earning capacity or profitability of the firm. Now, whether the company is earning profit or loss, or how much is the capacity of the business to earn profit or loss in the future, it is the one of the objective and also the importance of financial statement analysis. That means with the help of this financial statement analysis, we can know whether the firm is going to earn profits or suffer loss in the future, and also whether the company have the capacity to earn profits in the future or not. The next point is to assess the operational efficiency and managerial effectiveness. Now, what is operational efficiency? Operational efficiency means how the management is working in day-to-day work, how the operations is going on in the day-to-day activities of the business, and whether the managers are effective to take decision on this operational efficiency, whether the day-to-day activities are going on smoothly or not, and the managers are able to uh, find out the effectiveness of the business. It is done with the help of the financial statement analysis. Next point is to assess the short term as well as long term solvency position of the firm. Now, how to assess the short term as well as long term solvency position? Now, solvency position means whether the firm is able to exist in the market or not. They can be surviving in the market or not for a long period of time or for a short period of time. It can also be assessed with the help of financial statement analysis. The next point is to identify the reasons for change in profitability and financial position of the business. Now, if the profitability and financial position of a business are not same in all the years, right? If the company is earning profits in one year, in next year might be the profit they might not earn, they might suffer some losses, or it might happen that in one year they might have earned more profit and in the next year maybe the profit was less. So that changes changes of the profitability can be identified with the help of the financial statement analysis. And how to know the financial position of the firm? If there are changes in the profitability of the business, when we display the profitability changes in the balance sheet or the profit and loss account, then the financial position of the firm also changes according to how the profits were earned. Let's say in first year there was a profit and in the next year there was a less profit, then it will be displayed in the balance sheet and the profit and loss account, right? So this identifying the reason why there was a changes in the profits, why the profit has increased in one year and in the next year it went down, and why, or maybe why there is a loss. According to that, the balance sheet will show the result of it, right? So to identify the reason of this profitability and the position of the firm, financial statement analysis is used. Next objective is to make inter-firm comparison. Now, inter-firm comparison is like from one firm to another firm, what are the profitability position and the profitability position between the two companies or different companies can be compared with each other to find out which company is earning more profit and which company is earning less profit, or which company is suffering any kind of losses. So this inter-firm comparison can also be done with the help of financial statement analysis. Next is to make forecast about the future prospect of the firm. Now, financial statement analysis is helpful to know in for the future that whether the profit is whether the firm or the company is going to earn profits in the future or not. For that reason, there are many statistical uh, techniques are used to know whether the company have the potential to earn profit in the future or not. So to make forecast about the future prospect of the firm, by analyzing the financial statement only we can forecast it. Okay. Now next is to assess the process of the firm over a period of time. Yes, to assess the progress of the firm over a period of time, it is same as in this identifying the reason for change in profitability. That means if there is any kind of changes in the profitability of the business year to year, then how the firm is, whether it is progressing or whether it is declining, it will be for over a period of time, it will be displayed with the help of financial statement analysis. So the next point, we come to ratio analysis. Now, what is ratio analysis? Ratio analysis is one tool of financial statement analysis to help the financial managers, the accountant and the managers to run the business properly. Now, what is the meaning of ratio analysis? Let's see. Now, this ratio simply means one number expressed in another number. A ratio is a statistical yardstick by which relationship between two or various figures can be compared or measured. Now, what is this ratio analysis? Ratio analysis is a tool of the financial statement analysis which helps us to understand the relation between the two numbers and how those two numbers are related with each other. It shows one number with the another and how it can be compared, how the relation between one number and another number can be compared and measured. Now there are classifications of ratios, ratio analysis types. There are altogether 5 types of ratios, and under these 5 ratios there are again subpoints which is displayed in this graph. First is ratio analysis types. Now first ratio is liquidity ratio, profitability ratio, solvency ratio, turnover ratio and earning ratio. Now liquidity ratio, under this liquidity ratio we have 2 types of ratios which have to be calculated, that is the current ratio and the quick ratio. Now liquidity ratios are those ratios which can be utilized by the firm to convert the cash in shorter period of time. Liquidity means which assets can be easily converted into cash, and there are 2 types, that is the current ratio and the quick ratio. Now current ratio, it is showing the relationship of current assets and current liabilities, and quick ratio, it shows the relationship between the current assets minus the stock and any kind of prepaid expenses with the current liabilities. So all these items which are appearing in this table, in this graph, will be explaining this in the later classes in detail. So for now, this uh, ratios which are there in the graph, you have to be understood very carefully, and the formulas which will be given in each of these ratios have to be understood properly to solve the numerical problems. Hope you have liked this video. If you have liked, then please click on like, and thank you.